Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 12, 2017. Again, this week's stocks set fresh all-time highs, and today we'll look at gut feelings and what do they really mean, and do they really mean anything for trading. So my gut feeling is that we may take a pause during the summer. We're seeing more breadth divergences. And volatility index, the VIX, is multi-year lows. But does it mean that we're going to have a correction? We'll look at some historical examples. Again, several of the sectors hit fresh all-time highs. And then we'll look at financials, which may be ready to retest April lows. Junk bonds again set fresh all-time highs, but the investment-grade bonds also held their own. So we'll look at that. Dollar had an unimpressive week, but gold really had a pretty decent week, and especially GDX, the gold miners ETF, had a really good week as well. And my proprietary index, gold breadth index, improved significantly further. Also, we'll look at silver. Oil bounced for the week, but it has kind of like an inside week. We'll look at what I mean. Lots of overhead resistance, and we'll look also at energy ETF XLE, and finally finish off with natural gas as it pushes to fresh 52-week highs. Okay, let's start with S&P 500 ETF SPY. In this video and in general, I use all of my charts are adjusted for dividends. So even though S&P 500 itself may not have hit fresh highs, with dividends, adjusted for dividends, we did hit fresh all-time highs yet again this Tuesday. So I have a quote here from Michael Marcus, who is a market wizard, and this is from a book by Jack Schwager, Market Wizards. I highly recommend pretty much everybody who is serious about trading read this book. It's a great book. It really shows how many professional and very successful, importantly, very successful traders think. So gut feeling is very important. I don't know of any great professional traders that doesn't have it. So I'm not saying I'm, caliber of Michael Marcus, of course, but I do have a gut feeling. And my gut feeling is we have been kind of trading in this very tight range here, and we have not been able to really meaningfully break out of this range to the upside. We have not been breaking down either. So for now, it's kind of very tight trading range, and we're not really going anywhere. But we are in May. We're approaching, summer month. Sell in May and go away. Additionally, what I'm finding here is that we're seeing more and more pronounced divergences. So you can see on balance volume made a lower low. Advanced decline line almost made an all-time high, very close. So it's literally off by a point. I don't know how much to worry about. But the advanced decline volume line did not make fresh all-time high. So it feels like we may still, at the very least, retest the April lows here. And actually, when I get to financials, I'll show you what I mean there. So I'm not saying we're imminently going to have a major correction, but I think we are definitely overdue for some sort of a meaningful, at least a pullback of some sort. Here is S&P 500 itself. Here what I wanted to point out is a little bit, well, more pronounced divergences now. This is RSI, just good old regular RSI. Looks like we became overbought here in February, March, as we made fresh high back then. Now we did make fresh all-time high here, but we did not become overbought for RSI. So this is pretty clear, classic divergence. Now, how much to worry about? It's questionable, because those divergences are quite common. I am more worried about breadth divergences, and you can see the percentage of stocks above the 200-day exponential moving average is now at 71. Before, when we've made fresh high in March, we were at 85, so that's, obviously lower. And same goes for bullish percent index. We were at 79 back then, we were at 71 now. So there is a pretty clear divergence that's going on for the past few months. The absolute readings themselves are still quite high, so I'm not really worried about the bull market. We're clearly still in a bull market because we're still making fresh highs. But again, this is indicative of less stocks participating in the advance, basically. Okay, and here's a VIX volatility index. So there was quite a bit of news recently that VIX hit multi-year lows, and the last time VIX was this low was in 2007. And of course, everybody knows what happened in 2007. We had a big drop in S&P 500. You can see S&P 500 graphed here in the lower part, while VIX itself rallied. VIX is like a secondary indicator, truly. So you can't just look at VIX and say, since VIX is so low, we're going to drop. We could see a volatility expansion. In other words, we'll just get more choppy trading. Here in 1993, 94, 95 time, we had VIX also at very low levels here. And notice what happened afterwards. We had the initial spike here, and S&P 500 dropped like what, maybe 10% or so. So not really much to write home about. And then we pretty much traded sideways for the 94, 95. But then we rallied like over 200% into year 2000, and VIX was relatively subdued. So I would not just look at VIX and say, oh my god, look, we're at such low readings, that means we're going to definitely, S&P 500 is definitely going to drop. We need to look at the picture in more, from a bigger perspective, not just from one-sided VIX perspective. So here is a weekly S&P 500. We had fresh all-time highs here in the weekly time frame. During the week we did hit fresh all-time highs. We're still holding the gap here that happened 3 weeks ago. It's a very unusual behavior because weekly gaps are quite rare, but it is still holding. So maybe this is a still important. I mean, ideally we should break above this resistance 1 and just kind of trade above it. We haven't done it yet. So we're seeing that we're basically finding resistance here at the resistance 1 that I see here. And again, since the summer months are a little bit more difficult for stocks than the winter and the spring months, maybe we'll see a pause in the rally. So that's what my gut feeling is. And then when we get to bonds, I actually will show you that maybe there's more pieces to this. So here's S&P 500 on the weekly time frame, and what I did is I put a volume by price here on this chart, and this just shows how much trading occurred at various price levels. So number one, you can see a bigger volume here around resistance points, point 1, and that makes sense because we have been trading around this area quite a bit. And notice that there was not a lot of trading between like 2350 to 2200 because we kind of just moved straight up, and there was not a lot of back and forth. There was a lot of back and forth here at around 2100 or so, and you can see there was a lot of volume there. So this is a great support level, and it will take a lot of selling pressure to break below that. But I think we should concentrate on a more immediate term, and I think if we do get a pullback, I think the immediate pullback will take us to like March, April lows, and then if we fail that, then we'll need to worry about something else. Here is New York Stock Exchange Composite, a daily time frame. Here what I wanted to just show that you notice that we have been moving steadily higher here, but the advanced decline volume line kind of been moving lower, so the volume has been on the lower side, and also the same goes for the percent of stocks above the 200-day moving average and for bullish percent index. So you can see that we have been kind of moving lower in that department. We're definitely not in a bear market. I would say that if we move to like 30s in this numbers, then I would start worrying about a bear market. We're definitely not there yet. So technology, of course, QQQ, extremely strong move. Notice that it's just going. It just keeps going. And again, I wanted to point out that if you're a beginner trader, you should definitely avoid shorting stocks in general, and avoid shorting bullish stocks, well, in this case, bullish index in particular, because you don't know where it's gonna go. It just keeps going, and this is a classic short squeeze. They just gap above previous resistances and just keep going. So again, this Friday, all-time highs. Advanced decline lines are confirming the move higher. The XLK, it's a technology sector. It's actually quite similar to QQQ in its in a way, it's top holdings, but also fresh all-time highs. And this is again showing very strong and aggressive risk-on posture, at the very least in this department, in this sector, because technology is a very aggressive and risk-on sector. XLY, consumer discretionary, also an aggressive sector, and you can see all-time highs here as well. And I do see a confirmation from advanced decline line as well. So this is quite good news. Here we get into a little bit more choppy action. This is IWM, the Russell 2000 small caps index. So here we have been moving more or less higher, and we kind of just notice that we kind of been attempting to hold support around the 20-day moving average, but on Friday we kind of failed there. This is exponential moving average, and then we're at around 50-day moving average. So it's kind of been really choppy, with small caps. Additionally, we see quite obvious divergences on the RSI and also on the percentage of stocks above the 200-day moving average, and you can see another momentum divergence here, price momentum oscillator. So not a great chart, but also not a very terrible chart. It's been just kind of choppy basically. Okay, so let's look at financials, and this is a rather important part of the market. It is also offensive and aggressive sector, and it's been rather choppy, and I would say it's relatively weak compared to other sectors. So yes, we had multi-year highs, pulled back from multi-year highs, and like the rest of the market, basically we're at we're at April and 2017 lows here in April. Now we bounced off of them, but I don't feel like we're done with this yet. next chart I'll show you what I mean. But this is also, we are seeing all-time highs, but we're seeing a move lower in advanced decline lines. So not a great chart, honestly, because there is a bearish, you can see that there is a breakdown in the advanced decline volume line below. It's actually at lower levels here in April than it was during the beginning of the year. So it's a bearish divergence here, basically. But more importantly, I wanted to show the weekly chart of XLF. I think I showed this chart as well in the past. And basically here what I wanted to show is that I want to see a bullish candle, and I just don't see it, in this February, March, April, May time. This is a bullish candle right here, like in January. You can see that it's like a hammer candlestick, or this is a big white candlestick. Those are two nice bullish candles. Even this candle right here in December, it's a nice, bullish candlestick. But here I just don't see those bullish candlesticks. Yes, we do have this gap up here, but this candle that followed actually looks kind of like a shooting star, if anything. And the following candle, I wish it had a close next to the high, but it didn't. So what I'm seeing here is I still see quite a bit of weakness, and most likely we're going to retest April lows, and I wonder if we're going to hold there, because if you like the chart patterns, maybe this is head and shoulders pattern, maybe this is a left shoulder, a head, and this is a right shoulder, maybe it's a double shoulder, I don't know. So I wonder if we're going to hold here at April lows if we retest them. And finally, here's XLU, utilities. And here I want to quote a very famous quote, most likely pretty much everybody who read Reminiscences of a Stock Operator remember this famous quote. "It never was my thinking that made me the big money for me. It was always my sitting. Got that? My sitting tight." And here is the move that I'm trying to apply this to. We do trade this at MasterChartsTrading.com. I actually still have a position open. I opened my position in utilities in November, and I still keep it open because this move still continues, and looks like this is all-time highs, and looks like we are moving towards fresh all-time highs for utilities. So again, it's the sitting that makes good money. Okay, let's move on to bonds. So first of all, junk bonds, high yield bonds. They correlate highly to the general market, so I keep pointing out the fact that, in my opinion, I group them together with the stocks. They almost trade less like stocks. So anyways, all-time highs here for junk bonds. For now, this is looking rather good for stocks. And I just don't see that many signs of selling. I thought last week we had a bit of a selling bout, but that was really it. So let me just show you what I mean. On the daily, I thought that big red candlestick, but really that was it. There was no follow through whatsoever. I thought we were gonna get something like this again, but we didn't. So anyway, so overall, I think junk bonds are showing that there is good strength for stocks. In stocks. So let's look at first of all seasonality of AGG. This is aggregate bond fund, and this chart shows how many on average, how many percent did AGG close higher than it opened in each of the month, and you can see, for example, April is a really good month, May is a really good month, June is apparently not a very good month, but notice July, August, September, and even October, they're very rather strong months for bonds. So summer months are stronger for bonds than they are for stocks. This is almost exactly opposite for stocks. So here's TLT and the daily time frame. I actually had to zoom out a little bit. This is the 8-month chart now. So important thing here is this big gap here. So today TLT gapped up and then continued higher. So it looks like we have big white candlestick, a gap, a really large gap, and another big white candlestick. This is showing significant buying pressure. And this significant buying pressure is happening when stocks are at all-time highs. So why would this happen? I'm guessing the investors are feeling that maybe stocks are going to correct some. Maybe that VIX reading does mean something. So what they're doing is they're buying bonds for protection, because bonds usually do well during the periods when stocks go down. In fact, here is TLT on the weekly time frame, and notice this very hammer. This is just a picture perfect hammer candlestick right there this week. Hammer candlesticks mean that there were buyers that stepped in and sellers, the lower prices were rejected, buyers stepped in, pushed the prices higher. Notice that the close is above the open, so it's a hollow candlestick. So it's literally a picture perfect hammer candlestick, which in my opinion signifies that we have maybe have bottomed. We did run into resistance here from previous broken support, but this looks to me like we have bottomed and may actually continue higher for TLT. Here's AGG with a similar looking gap. This one is some, hollow red candles are, in my opinion, quite bullish. Notice we had a hollow red candlestick, enormous gap, and another big white candlestick. Well, not enormous, pretty big gap. Here's another pretty big gap, but on the bearish side. So looking like we have bottomed here for AGG as well. Here is a weekly candlestick for AGG. This candlestick looks very bullish to me. One of my most favorite bullish candlesticks is that we have a rejection of lower prices, so a long buying tail out of the bottom, and big white body, hollow body with a close near the top. So this is very bullish candlestick to me. Finally, LQD here, the investment grade corporate bonds with a similar picture, but notice that we are even. I'll zoom out to 8 months. Maybe I should compare apples to apples, I guess. So also stronger. Notice how much stronger this chart is. We are above the 200-day moving average for LQD. Let me show, but on AGG, for example, we just gapped above it, but on TLT, we're still well below it. So notice that as we move, I guess, down the quality ladder, the strength in the bonds increases. So LQD right now is the strongest of the 3 major bond funds, and here it is on the weekly time frame. Also a very bullish looking candlestick. Notice that we barely even dropped that much, and we had hammer like candlesticks for the past 3 weeks here, and then finally we surged here this week. Again, a very bullish looking candlestick to me. So to summarize, I think bonds are moving higher, and there has to be a reason for that, especially now that stocks are at all-time highs and VIX is at almost all-time low. So perhaps the investors are positioning themselves for a little bit of protection for the summer month. All right, let's move on to the dollar and the forex universe. before we move on to gold, because it's very important to gold traders to know what's going on with the dollar. So here's US dollar on the daily time frame. You could say that we're seeing a series of higher highs and higher lows. Or rather, I'm sorry, you can see that we're seeing a series of lower lows and lower highs. Perhaps this is a lower high, especially if we move lower and take out the recent May low here. And I think if we do, I think the door will be easily open to November, a retest of November lows for the dollar. Of course, if that happens, I think gold will benefit. Here's the same chart on the weekly time frame. Now, I still think this is a bullish chart. Maybe this is a cup and handle, and where it's still drawing this handle. Maybe this is a fallen flag. But if we move lower and break this fallen flag formation, then we'll most likely retest November lows. Alternative scenario is a move higher and a breakout above 101 here, which could still happen. In fact, if I was trading, forex, I don't normally trade forex, but if I was trading forex, right now I would be short in euro. Actually, this is a weekly time frame, and I actually found that it's easier to zoom out more and trade more volatile securities on a more zoomed out charts. Sometimes it makes the picture much more clear. And here, I think that this is still a bearish chart, and I think I would be shorting it. So I think right now actually would be a pretty decent time to short euro with a possible outside reversal here. Almost outside reversal on the British pound, almost like a bearish engulfing here. Same thing, I would be shorting it right now, honestly. US dollar versus Japanese yen is the opposite, so yen is dropping here. At the beginning of the week, well, during the middle of the week, we had this candlestick for the week actually was really strong. We were up here, but then we really sold off by the end of the week, so it's still sort of indecisive. Maybe we broke out of this fallen flag. I think still that ideally we should break out above like 115.5, above this level 115.5, and then maybe once we break out we'll continue higher. In other words, the dollar will gain versus the Japanese yen, and if the dollar gains versus Japanese yen versus the British pound versus the euro, then of course the dollar index will move higher. Here this weekly candle is relatively weak, indecisive, and there was selling at the end of the week, so I cannot say that this is a bullish candle. If we had something like this big white candlestick, and then but even those candlesticks sometimes fail, so again, it's not always possible to decide just by looking at candlesticks what the price will do in the future, obviously. So overall, I still think this is a bullish chart. I would not short it just yet, but I think if we break November lows, then I would be more worried about it. But for now, I still think this is a bullish chart. Okay, so let's move on to gold and gold miners, and today we'll do a little bit different than we usually do. I usually finish up with this chart, but today I wanted to actually start with this chart. So this is gold miners ETF GDX on a daily time frame. Here we have gold breadth index. It's my experimental indicator which attempts to call the gold bull or bear market. Notice that we have improved now to the highest level possible. It's now at 4. So this is a positive sign. And the reason why we have moved up to 4 is because of this sub-indicator. So this indicator is kind of like a part of the total market breadth index for gold. So here we have percentage of stocks on a buy signal within the GDX. And notice that we had a bear trigger that occurred in October of last year. And since then, we have not been able to achieve a bull trigger. But we had a momentous occasion, and it happened just this week. So it looks like we now have a bullish trigger for this indicator, which is actually great news. And my bullish thesis for gold and gold miners is still alive and well. So let's go to gold now and look at it in more details. Okay, so here's gold in a daily time frame. It looks like it really wants to bottom here. I only wish that we had a little bit of a stronger close here on Friday. We kind of sold off by the end of the day. Not a great candle here on Friday, but what are you gonna do? So I wonder if GDX is leading the charge higher, or if maybe gold will roll over, or maybe gold will catch up, or vice versa. Maybe GDX will need to wait for gold to catch up. Because here you can see gold on the weekly time frame, and this candlestick is not very bullish, even though it is a hollow candle on the weekly time frame. I wish we had something like this, where we had a bigger real body, but we have more of a spinning top, so this is more of an indecisive candlestick. Nevertheless, it's definitely better than a red candlestick. So here is a longer term perspective. I've showed this chart in the past again, and this is that gold breadth index that I just showed on a longer term time frame. So notice that basically here in 2012 this index already called the bear market. So all of these counter trend rallies, I would have shorted them. And in fact, when we started our MasterChartsTrading.com back here, we were in fact shorting them, shorting those rallies. But here in April of this year, of 2016 rather, we had a breakout above previous highs, which was confirmed by the market breadth index for gold for by GBI. We went kind of back and forth here, but finally again, now we're at 4, and this is the highest reading, so we're not in immediate danger of going back into a bear market. If you listen to my previous videos, I consistently said that we were in danger here of rolling into the bear market, but looks like right now, at the very least, we're not in imminent danger, which is good news. Here's GDX on a daily time frame. Again, here's the gold price index, so improvement in there. Here what I wanted to point out is that number one, we did close above the 50-day moving average. That's very good news. Let me see if we have new readings, because these are from May 11th still. Oh yes, we do have new readings. So this is 4643, 4668. Okay, so this is now less negative, which is good. In other words, now we have a little bit of a bullish divergence. So Friday's high in advanced decline volume line is minus 4643, and previous peak was more negative, minus 4668. So it looks like we have a bullish divergence here, which is very good news. So bullish divergences are great. Here we had, I pointed this one out last week, even though we made a lower low in the actual index, we had higher lows in the advanced decline lines and the bullish percent index. And this is a BPGDM, which is kind of hiding behind there. So we had the bullish divergences, and looks like they are playing out. So this is definitely good news. I think gold will, well, hopefully it will catch up to GDX, because it does feel like it's kind of running, GDX a little bit running away. Same chart as I just showed for gold. Similar attempts at breakouts. Finally, we had a breakout here in 2016. Looks like we came back to around that area to retest the breakout. And for now, we have succeeded, which is, again, good news. And here is gold on GDX, rather, on a weekly time frame. I like this candlestick a lot. So we have definitely a bullish looking candlestick, almost a bullish engulfing pattern. The close is above the open, the close is next, relatively close to the high of the week, and there is a buying pressure present at the bottom of the candle. So this is so far looking pretty good, and hopefully we'll continue higher from here. So this chart I already showed. Another indicator I have is intermediate term Bread's momentum oscillator. I did not invent this indicator. Just for the record, you can look in chart school and there's a calculation for the ITBM, but I just applied it to the GDX because there was no MasterCharts.com does not provide ITBM for GDX, so I made my own. So we were a little bit oversold here for just a few days, and now looks like we have. Sometimes this is a good signal, sometimes it's not a very good signal. I don't normally use indicators to trade. Notice what I said. I don't use indicators to trade. I use them for setups. Because indicators, by and large, they give quite a bit of false signals. For example, here's a indicator. Even this one was a great signal right here when we had this line cross. We had an enormous move up. But here we had a line cross right there in November, and then nothing happened. And then another line cross, and in fact we dropped down. So indicators, in my opinion, should be more, should be used for as a setup, and then you should look for like a presence or absence of buying or selling pressure if you're shorting. Finally, here I wanted to show silver, and it's been in the news because we had just non-stop selling for 3 weeks. I think it's some sort of a record for how many days in a row silver continued lower. Now, silver and gold correlate very highly. So if gold is moving higher, I don't see why silver shouldn't either. In fact, here is a hammer-like candlestick on silver. So maybe this is it for the move down, and maybe we'll find a support here and move higher from here. Okay, let's move on to oil. This is West Texas Intermediate light crude oil. So we had big sell-off here from April highs, from the previous area of resistance, broke the March lows and continued lower, but then we had a big hammer-like candlestick and then kind of bounced higher. So right now we're in this area of resistance from the broken support. Whether or not this resistance will reaffirm itself, I guess, remains to be seen. So I guess we're seeing a little bit of selling already, selling pressure, because you can see that there's a selling shadow out of the top of the candle here, but not a lot yet. So maybe we'll kind of meander here, and then maybe we'll see another selling come in. Now, I think this is a bearish security. In fact, we are shorting it at MasterCharts Trading. I still have a short position open, so once I close it, I'll show you the position. The reason why I think it's bearish, as I've shown this in the past, is because oil is to me clearly in a downtrend. And even though those are 52-week highs, those were quote-unquote accidental 52-week highs, just because this bounce from multi-year lows from February 2016 took this long. But the resistance did reaffirm itself in the $55 area. We had one big candlestick here, and this is a weekly time frame in March, and then another strong selling in April, May here. So definitely I think it's bearish, and I would not go long oil unless you're doing some short-term trading, of course. Here's energy XLE rather. I showed this chart in the past. Even though those are 52-week highs, they were not confirmed by the advanced decline lines, and I was kind of not very comfortable going long on them. Eventually we turned around together with oil, and we started hitting multi-year and 52-week lows for the advanced decline lines. Also the bullish percent index for XLE is very low readings. It did rebound a little bit, but I still think we're not out of the bear market. Here's XLE energy on the weekly time frame. Notice that energy XLE was a leading indicator to oil decline on 2 occasions. So you can see energy dropping here in 2015, oil trading sideways, finally oil dropping. Same thing here in 2016-17, energy declining, oil trading sideways, finally oil dropping. So if the 2015 decline is to be an indicator, it doesn't look like we're done yet. Additionally, I'm not, it's just, you know, energy just really can't catch a bid. I mean, this looks kind of like a hammer candlestick, but it's a filled body, so not a very strong one. And then this week again we started out strong, but then we sold off by the end of the week. And notice that there were just not that many strong I don't see any strong candlesticks here since December of last year. This is a strong candlestick here in December, and this is a bullish candlestick, but I just don't see any good looking candlesticks just yet. So maybe eventually we'll bottom out here and attempt a rally, but I just don't see it yet. Finally, natural gas. This is a weekly time frame. I think it's a bullish chart, and I would not short this chart. But then again, I always warn about natural gas. It's a crazy volatile security, so be extra careful if you're new to this. And what I mean extra careful is that you can simply trade smaller, simply take smaller positions. If you are risking $100, cut it down to $25. It's okay, as long as you learn how to trade. Then eventually you can, increase your bet size. But anyways, natural gas, bullish. We had a basically we held support after this really deep pullback, held support here, nice big white candlestick, very nice looking, one of my favorite candlesticks really, right there. And then we rallied, another really strong candlestick this week, so looks like we're going to attempt to retest 52-week highs here. Alright, if you like what you're hearing, please like this video. If you have any comments, do comment below. And of course, share this videos with others who might benefit from it. Please stay tuned on how to find us on the internet and consider signing up at MasterChartsTrading.com. Thanks for watching and have another great trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.